If you clicked on this video, you're probably getting stopped out too much. Now, in my personal opinion, there's a very specific reasons or maybe multiple different reasons why you may be getting stopped out too often. So in this video, I'm going to show you exactly why your stop loss might be causing you to fail in trading. See, a stop loss placement is way more important than people might think. There are certain areas in price action that price is less likely going to return to, and it is essential for you to know these different things. Because if you don't know where price is likely not going to visit again, well, then you're going to have a very hard time finding the right stop loss placement for your trades. So in this video, I'm going to show you two different examples that I personally use for my stop loss. These two examples is basically the only places where I will place my stop loss. So without further ado, let's jump onto the charts and let me show you exactly how I place my stop. So taking a look at my screen, the first place that I would like to talk about, which is also one of the greatest places to place your stop loss, is what we call intermediate term lows and intermediate term highs. So that right there is what I personally would classify as an intermediate term low, because this low is a swing low. Now, a swing low means that there's three candlesticks. The one in the middle is lower than the two next to it. And that is exactly what is going on in this picture. Now, not only is it a swing low, we get multiple of those. We get probably hundreds of those throughout a day. However, it is a low that filled an imbalance. So right here, we have a fair value gap. We have a swing low that filled the entire imbalance. That is what I call an intermediate term low. Now, if you know anything about imbalances or liquidity, you know that these two things is what attracts the market. Therefore, if we have a low that's already filled an imbalance, like this one right here, well, then the market technically has no reason to come down lower again. Now, this is, of course, only true if you get the order flow of the market right. Intermediate term lows are obviously only meant to hold in bullish markets. Meanwhile, intermediate term highs are obviously only meant to hold in bearish markets. So again, it is essential that you learn how to analyze the market yourself, that you learn how to tell what the order flow of the current market is. Are we bullish or are we bearish? My favorite way of doing so is by looking at previous price action. Are we holding bullish PDRAs, or are we holding bullish fair value gaps, or are we failing to hold bullish fair value gaps? So if we're holding bullish imbalances and violating bearish ones throughout the entire day, well, then the market is likely bullish. Vice versa, if we are holding bearish PDRAs but violating bullish ones the entire day, well, then the market is probably bearish. And that is sort of how I will figure out what the order flow of the market is. And if I, in this scenario, figured out throughout the entire day that the order flow is bullish, and I can therefore anticipate that this is going to hold, well, then this is a place where I would want to place my stop loss. This is also great for trailing stop losses. A lot of people have a hard time figuring out where they should trail their stop loss to whenever they're in a trade. My favorite way of trailing my stop is to intermediate term lows and intermediate term highs. Again, if you are long, you can trail your stop loss to all the intermediate term lows that we are creating along the way. Vice versa, if you're bearish, you can trail your stop to all the intermediate term highs that we are creating along the way. That is, in my opinion, the safest way to trail your stop loss, and that is what I personally do. Other than that, intermediate term highs and intermediate term lows are so great because they also will tell you whether the market switches direction. So a lot of people have been taught regular market structure shift. You know, a bearish market structure shift is a closure below a down close swing low, vice versa. Now, the high probability market structure shift, in my opinion, is the closure below intermediate term lows and intermediate term highs. Because again, this is supposed to hold if the market is bullish. So if we get a candle closure below that swing low, well, then the market is probably not bullish, right? So these are the strongest market structure shifts that you could get, which is also why it's super convenient for me to place my stop there, right? So if I end up getting stopped out on an intermediate term low, it means, again, that the market is not bullish and I no longer want to be in a long. So it's a perfect place for me to place my stop. Realistically, all you want to do with your stop loss is figure out a point in price where if we come back to that area, the order flow of the market or the thought that you had of the market is invalidated. That is essentially what we want to try and get at. And the things that I'm showing you in this video are places in price where I am in no doubt whether my position is going to work or not, or if I was right or wrong. Because if we sweep an intermediate term low and I am long, well, then I was wrong. And that's exactly where I want to place my stop. You want to place it in an area where if it goes here, well, then I simply have to accept that I'm wrong. that is where you want to place your stop. And for me, one of them is intermediate term lows and intermediate term highs. We'll take a look at real chart examples later on. The next one is going to be SMTs. This is also one of my absolute favorite ways of protecting my stop loss, is to put them at SMTs. Now, in case any of you are confused or don't know what an SMT means, it's basically when you have two correlated assets. So in my case, I trade the NASDAQ, and the correlated asset to the NASDAQ is the S&P 500. So if we have a low right here on the NASDAQ, we also have that same low on the S&P 500. If the NASDAQ sweeps that low, which in this example it did, and the S&P does not sweep that low, that is a bullish SMT. Now, just like the intermediate term lows, if the market is bullish, well then this SMT should hold, which means the S&P 500 should not come down and sweep this low, and the NASDAQ should not come down and sweep the low that it's just made, which is why I want to place my stop at SMT lows, because again, if the market ends up running lower than the SMT and invalidates the SMT, well then my whole trade idea is invalidated and I should no longer be looking for longs. So again, SMTs and intermediate term lows is going to be my absolute favorite place to place my stop loss. That is simply where I feel the most safe, because again, if my stop gets triggered, that is an automatic tell that, okay, I was wrong. Obviously, you're always wrong when you get stopped out, but there are certain times when you will get stopped out and the position continues to rally in the direction of your take profit after you've gotten stopped out. These two stop loss placements, in my opinion, rarely will give you that, simply because they say so much about the order flow of the market. So if they get violated, well then the order flow is probably bearish. And that is exactly how I want to manage my stop losses. So without further ado, let's jump onto actual charts and let me show you some of these examples playing out with actual price action. Before we do that, I have a trade that I took the other day utilizing SMTs for my entry and my stop, and that will kind of showcase what I mean by using SMTs as a stop loss. So let's take a look at that real quick. So right here is an example of a position that I took just a few days ago. This is a very intraday scalping trade, but it showcases exactly how I utilize an SMT to my advantage. So if we take a look at the chart on the left, that is the NASDAQ. The chart on the right is the S&P 500. Okay, notice how the high here got swept by the S&P 500, but it did not get swept by the NASDAQ. That's a bearish SMT. Now, the only reason why I'm anticipating this to hold is because we have a 15-minute unmitigated imbalance down here, as well as equal lows. So I'm anticipating bearish price action until this is hit, and therefore this SMT should hold until this is hit. That means if I have an SMT at this high, I want to place my stop loss at that high, because if the SMT is invalidated, well then the order flow is probably not bearish, because again, if it was bearish, well then the SMT should hold. And if we sweep the high, well then we don't hold the SMT. That is exactly how I use SMTs to my advantage, or to my stop loss advantage, because it will immediately tell me if I am wrong, right? Because if we end up invalidating the SMT, well then the whole idea was probably wrong, and that's exactly where I want to place my stop. I know I'm repeating myself, but I really want you to understand. So placing my stop at the SMTs is one of my favorite ways of making sure that I am safe in my position. So right here, we're looking at a pretty good example of a 15-minute intermediate term low being formed. If I mark out this 15-minute imbalance, you'll see how we wick down. We didn't close below, okay? That's very important, because if we close below, that invalidates that fair value gap. Now, if we just wick below, fill in the imbalance, right, and then move higher again, if this now becomes an intermediate term low, we should see this being a swing low, which means the next candle cannot be lower than this one. Let's see. And it became a swing low. So currently, this right here is an intermediate term low, because it is the candle that filled in the imbalances here, and it's also a swing low. So according to my theory, if we're bullish, this should not be broken. So now let's see what happens here on a 2-minute chart. As you can see, that low right here is still holding up, right? It's sort of being protected. So what we could do here is look for some sort of entry. For example, we could utilize that breaker right there, see if we're going to get filled on that. Stop at the intermediate term low, remember that, and then we can put our take profit at external highs. So let's see if we're filled. We're filled right there off of previous structure, or the bullish breaker block. So now let's see what happens. So now this trade was a little longer than expected, but as you can see, price came very close to that intermediate term low. 1, 2, and 3 times, okay? But it never swept the low, which is why I enjoy placing my stops there, because again, it's just a great way to make sure that if I get taken out of my position, well, then I know for a certain that I was wrong, and I'm fine by getting stopped out if I'm wrong. The worst case scenario for a trader is getting stopped out and being right? The trade continuing to run towards your take profit. That's what we all want to avoid. I don't think a lot of us has a problem with being legitimately wrong. It's okay to take a loss when what we did was wrong, or we simply got the idea of the market wrong, right? And the easiest way to make sure that almost every time you get stopped out, you are wrong, is by utilizing these intermediate term lows and SMTs. So yes, this was a very, very long trade, but again, the low stayed open, right? Which is all I wanted to showcase off of this video. So these intermediate term lows are just a great way to sort of make sure that if you get stopped out, it's because you're wrong and not because of unlucky stop loss placement, right? That's the whole point of this video. And right here is another example of an intermediate term low being formed. We have a low that filled an imbalance. That right there is an intermediate term low. But again, only because it's a swing low, right? This low is lower than this low, and it's lower than that low. So we have an intermediate term low, which means I'll go on a 1 minute time frame. I'll utilize something like my optimal trade entry tool, and I'll utilize that to get an entry in price. Put my stop again at that intermediate term low. It's very important. I'm going to put my take profit at external liquidity, which is up here. Now let's see if we can end up getting filled here. And we did end up getting filled. Now notice how close we were to getting stopped out. Very, very close. But again, the low ended up holding, which means I am going to remain confident that the order flow is bullish, because even though we get close, that's fine. We can get close to the low. As long as we keep it open, well, then I'm pretty confident that the order flow is bullish. And that's exactly what I want to get at when it comes to my stop loss. So just another perfect example of an intermediate term low holding price, and then eventually sending it higher. So even though we come close, that's fine as long as we keep it open. Sometimes we'll even wick below, and that means that you're unlucky, and we could still go higher. But when we close below these intermediate term lows, that is when I am very, very confident that the order flow is now switching. In other words, intermediate term lows and intermediate term highs are also some of the best ways to utilize a market structure shift. So let's quickly take a look at another example. These were some trades that I had taken last week with the team, but here's a perfect example of why I was trusting my stop loss in this scenario. So I entered off of the optimal trade entry right here. Now, as you can see, price came very close to stopping me out, but I remained confident in my analysis simply because I knew that if we came down here on the NASDAQ, the S&P 500 would sweep this low before the NASDAQ. So I had pre-calculated an SMT into my stop loss calculation without the SMT actually being there yet, because I took a look at the S&P 500 and I saw that it was way closer to this low than the NASDAQ was. So if we were going to sweep this low, the S&P 500 would sweep it first, which means we would get a bullish SMT. And if we get a bullish SMT, well, that means if the order flow is bullish, that is going to hold, which is why I was so confident in this stop loss, even though price came very, very close. As long as it stays open, I don't really care how close it gets. As long as it stays open, the order flow is still bullish. And that is exactly why I utilized the SMT divergences and intermediate term lows and intermediate term highs as my stop loss. So I hope this video helped you out. If you have trouble getting your stop loss right, try these things out. And remember, you don't have to have a tight stop loss. You can have a larger stop loss. You don't need 5-hour trades. You don't need 10-hour trades. You just need a 1-to-1 trade or a 1-to-2 trade, depending on your system. So having a larger stop loss can be very forgiving, and it can be a very good way to let the market do its thing and you still being right. A lot of people get stopped out because they simply have too tight stop losses. They don't even allow the market to give a pullback within their stop. They don't allow it to do anything, which is why a lot of people are failing. And a lot of people will come to me saying, I always get stopped out and then price rallies towards my take profit. It's either because you don't know where you're putting your stop loss, or you're keeping a way too tight stop loss. So don't be afraid to loosen up a little bit on your stop losses, and then obviously try to follow what I've just taught you in this video. These were my absolute best tips in terms of stop loss placement. I hope that helped you out, and I'll see you in my next video.